Welcome to Tesla Deep Dives.
The pivotal topic on our agenda today is From Billion-Dollar Bet to Bust, Decoding the 4680 Battery Crisis and the Cybertruck's Supply Chain Risk. From battery day hype to a stunning financial reversal, the story of Tesla's 4680 cell and its flagship consumer, the Cybertruck, is the definitive cautionary tale of ambitious vertical integration. The promise was a 50% battery cost reduction, but the reality is a supply chain crisis epitomized by the sudden 99.99% collapse of a major supplier contract, forcing us to ask, is this billion-dollar bet now a bust? The 4680 cell, named for its 46mm diameter and 80mm height, was unveiled in 2020 with the revolutionary goal of enabling a structural battery pack and utilizing a complex dry cathode process. CEO Elon Musk claimed this innovation would reinvent the production process and slash battery costs by 50%. However, the initial mass production target of 2021 was missed, and the cell only reached small-scale production around mid-2024, representing a multi-year delay that postponed key vehicle launches.
The delays were rooted in critical technical bottlenecks. Internally, Tesla struggled with manufacturing yield, which stood at roughly 92% by the end of last year, significantly below the industry's estimated 95% required for commercially attractive costs. Compounding this, the current 4680 cells achieved an energy density of approximately 265 watt-hours per kilogram, nearly 20% lower than the anticipated 330 watt-hours per kilogram specification. This gap directly translated to the Cybertruck's range of about 547 kilometers, a major shortfall from the earlier 800-kilometer target.
The Cybertruck was the primary vehicle slated to utilize this technology at scale. In the Q4 2023 earnings call, Musk was bullish, stating the Cybertruck was production-constrained, not demand-constrained, and projected a ramp-up to 250,000 Cybertrucks a year in North America. Yet, the production ramp has been notably sluggish. Total sales in its first year, 2024, were only an estimated 35,000 to 50,000 units. In early 2025, reports emerged of Tesla throttling down Cybertruck production and shifting workers to the Model Y line, indicating that inventory was piling up and demand was an issue. The supply chain vulnerability exploded into the public eye in late 2025 when South Korean supplier L&F Co. announced a catastrophic write-down of its high-nickel cathode material supply contract with Tesla. The deal, initially valued at $2.9 billion, was reduced to a mere $7,386, a virtual wipeout, with the supplier citing changes in the supply volume. This unprecedented event suggests either a fundamental inability for Tesla to execute its high-volume 4680 production or a demand collapse for the Cybertruck, or both, as the vehicle is the primary consumer of this high-nickel chemistry. The skeptical narrative is currently dominating the financial conversation. Analyst firms like Morgan Stanley have reacted to the poor ramp-up and L&F news by revising their Cybertruck delivery forecasts to fewer than 50,000 units for 2025. The public discourse on X and community forums echoes this sentiment of disappointment, with many tracking production delays and citing softening consumer interest. Battery pioneer Stan Whittingham, a Nobel laureate, captured the critical view, stating that while he believes the challenges will be solved, it won't be as quick as he likes. Despite the major headwinds, a counter-bullish narrative persists. Tesla reported a strong internal ramp-up, with 4680 production growing 51% in Q2 2024 compared to Q1, with VP Lars Moravy confirming they were reducing COGS significantly. Furthermore, the time it took to move from the 50 millionth to the 100 millionth cell took just 3 months, compared to 29 months for the first 50 million, demonstrating impressive exponential scaling capability. Analysts reiterating a strong buy rating with a $305 target are betting on the ultimate success of the dry cathode process to significantly enhance margins in the future, justifying the short-term pain. The most profound strategic implication is the 5-year product vacuum created by the 4680 battery delay. The Cybertruck's reliance on this troubled cell has diverted resources, pushing back the mass production of its much-needed, affordable mass-market model to at least Q2 2025. This delay has left the company competing with aging models in an increasingly fierce global EV market, especially as key competitors ramp up their own large cylindrical battery solutions.
The main takeaway is that Tesla's culture of extreme vertical integration, a reinvention of manufacturing, has again proven to be a high-risk, high-reward strategy that is currently in the high-risk phase. The L&F supplier collapse and the subsequent throttling of Cybertruck production provide tangible, quantitative evidence that the skeptical view, focused on current execution challenges and demand shortfalls, currently holds the dominant sentiment over the long-term, potential-driven bullish narrative.
To gauge the future success of this bet, investors must closely monitor three key metrics. First, the Giga Texas 4680 yield rate, which must sustainably climb past the 95% commercial benchmark. Second, the Cybertruck inventory level and any reversal of the production throttle down. Finally, the next earnings call commentary regarding the L&F contract situation and specific timelines for full-scale dry cathode integration to achieve the 50% cost reduction target.
Let me know what your thoughts and leave your comments. Thank you for joining us for this crucial deep dive. To ensure you never miss a pivotal analysis, please like the video, subscribe to the Tesla Deep Dives channel, and hit the notification bell. Your engagement fuels our critical research.